range-bound stocks. I'll get into some explanation for those who are not familiar with that concept, but this will be for range-bound stocks, and I'll be showing you some of my ideas and thoughts around executing options trading around a strategy called Iron Condors. And throughout the presentation, if there's any questions, please either raise your hand on the Teams bar or feel free to just ask the questions. I'll also ask if there's any questions that we move from section to section. This is being recorded, and the recording has already started. And I also want to put up this notice here about the risks and so forth around swing trading, day trading, short-term trading, options trading, futures trading, etc. So I'm going to leave this up here for about 30 seconds for everyone to read. It will also be in the slide deck that I'm going to be uploading to the proper channel, and I'll send out the link to the recording and to this slide deck after this meeting has concluded. So I'll just be quiet here for a second so you guys can finish reading this disclaimer here. Okay, all right, if there's not any questions on that, I'm going to move forward. So the first thing I want to touch base on there are many factors, as you can see here, that impact the pricing of options. So the stock price itself, the strike price, which is the price that you're choosing as your exercise price. We'll get into that a little bit more. The expiration date and the days till expiration. There's a time component called theta that comes into play here. There's also interest rate and dividend factors. I'm not really going to get into that at this point in time. I mostly want to focus on the items in the yellow highlight, which leads to the last one, the volatility, or what's considered the risk for that particular asset. It could be also risk in the sector, risk in the overall market, global, other economic stuff, but volatility is all around that unknown outcome of a certain risk that may or may not happen at this point in time. So as part of volatility, implied volatility is the indicator that I keep track of from my, from my personal, perspective, what I found to work well for me and so forth. Implied volatility, or IV, is relative for each and every stock. So you could have a stock that has very high IV, but itself it could be not very high relative to historical data for itself. You could have another stock that has a lower IV than the aforementioned stock, but when you look at the percentile and the IV rank, which we'll get to, it is higher than normal based on the previous historical time period. So main point here is to make sure that you understand that implied volatility is relative for each and every stock in and of itself. Okay, if there's no questions there, I will move on to the next screen. So the next three screens, I just want to kind of a blurb about a couple things that I think are important in general around option prices and contracts and so forth. So here it is, the more time there is until an options contract expires, the greater the opportunity for the underlying stock's price to move and increase its value. As we get closer and closer to the expiration, the impact of theta accelerates in a non-linear manner, which is an advantage to credit traders. So this particular strategy, along with the credit spread that I have put out and posted last week on the channel, which you can feel free to go and review, these are credit spreads, which means you're going to sell to others the particular option, whether it's a call or a put or a combination, you're going to be selling that. So theta acceleration is, which I'll explain later in this session, is us credit traders benefit from that theta acceleration. And I want to kind of give an analogy before I move off this page here. If you're up on the top of a hill and the hill's sloping and then continues down to the ground level, and you're at the top and you have a boulder, say. And if you were to push that boulder, initially it's going to roll, and it's like rolling slow and slow, and then but making its way down. But then as it continues to hit the slope greater and greater, it moves faster and faster. It's accelerating at this point in time until it gets all the way down to the bottom and it crashes down to the bottom. So you can kind of see the same sort of time decay slope or theta decay slope happening with options as well. You could be 90 days out, for example, and you could have a relatively flat slope at that point in time. But as it moves closer and closer to the day of expiration on that you've chosen, it's going to accelerate faster and faster. And then and you'll see my criteria, but from the 3-week period all the way down to zero, that's where the time decay really eats up the price. And that's what we want to do is we're going to sell as credit traders. We're going to sell the options, as I mentioned. We're going to get a premium for that. And the time decay, as we're getting closer and closer to expiration, is going to eat away at the price of the option, decreasing that option so that when we choose to buy it back or we can let it go to expiration, that price will have eaten it down to basically nothing at that point in time. So there's no questions. Okay, I'm going to move on to the next screen here. The other thing I want to mention is if the implied volatility is greater than the historic volatility, which we'll see in a chart shortly, the options may be considered overvalued. And if the IV is less than the historical value of that historical volatility, the options may be undervalued. So as the underlying stock becomes more volatile, implied volatility can be expected to rise because of the unknown, the risks and so forth. As it becomes less volatile, the implied volatility can be expected to fall. So if you're going to just buy a call or buy a put, and you believe the trend is going to, for that stock is either going to be up or down, hence either the call or put, if the implied volatility is below the HV and is considered low at that point in time, that's a great time to be just buying calls or buying puts. However, if the implied volatility is high and is above HV or just high in general relative to other levels of that stock over the next period of time, then that's a good time to be a credit seller. Because that means the premium that you're going to get is, it could still rise, but the likelihood or the statistical probability of it rising decreases tremendously, so that it's statistically on a credit trader's side that the decay of the option will start and continue at some point. And as we talked about the analogy of the slope and the boulder, the same thing will occur with the implied volatility, which then impacts the options prices. So as a credit trader, we want to see overvalued or high implied volatility stocks and options in order to put us in the best position to be successful. So any questions? Okay. And the last thing, we kind of touched base on this already, but credit spreads are named appropriately because you will receive credit at the initial point of the trade, usually in the form of cash into your trading account. So what that means is if you sell options on stock XYZ, you're selling it, and let's say you get $400 of premium for that contract that you sold, the trade that you executed. That $400 will immediately go into your trading account. Doesn't mean you can withdraw it and stuff like that at that point in time, because there'll be some margin depending on the type of trade that you're putting out there. But it is going into your account. You'll actually see it in there, and then we're going to work out some exit strategies as I move forward in the session, and you'll see the changes and the benefits to your account if everything is moving forward. Any questions on that one? All right. So, as I mentioned, I want to look at ranged base strategy here called the Iron Condor. And let me pull up a chart here that I want to start with. I didn't. right. Where did it go? Oh, I see. Okay. You can all see my chart here. I just picked a stock up here, CCK, I'd been looking at last week. These, you'll see that there's support and resistance zones on here. I'm using a tool that GTS sells. It's called the xBrat Guardian Zones. It will build your support and resistance lines automatically and dynamically. So throughout the day, if anything changes, it'll automatically pop up on here and you don't have to worry about drawing your own lines and so forth. And there's different cadences or time frames, the 1 day, the weekly. If you're trading on an hourly perspective, you'll see hourly, 30-minute, 15-minute as well, 4 hours and so forth, all depending on your time frame you have on your chart. So anyway, let's ignore these. Let's look at this CCK right now. And starting in July, this is on a daily chart. So starting on July, you can see that between July and about October, the CCK stock was pretty much range-based in between, let's say, I don't know the exact number here, but like maybe 97 and 80, let's say 84. So it was range-based between 97 and 84. If you find yourself in that position where we're in a range-based area with the stock that you're interested in, and you want to use a strategy such as the Iron Condor that could be profitable for you, then that's what I'm going to show you on this particular strategy here. So, but I just want to kind of go through and show you the concept here of where we're range-based. We're not over here, you can see moving from June to August, we're kind of in an upward trend. From September to October, we are on a downward trend. But in this particular time frame here, over to here, you can see we've been in a sideways or a range-based trend. Any questions? I'm just basically getting some visual definition around range bounds at this point. Okay. All right, let me go back over to our Condor page. Excuse me. So an Iron Condor is a credit spread, which means you'll be bringing in premium to your trading account. And this credit spread strategy is multi-legged. There's actually two verticals here. I denote and bring attention to the two verticals because if you look at my sessions from last week on credit spreads, we talked about the credit spread, the bull put and the bear call credit spreads, which are just one vertical. Feel free, like I said, to go back and look at those. If you have any questions, even on that one or this one, feel free to type them in on the Teams channel. I'll be glad to answer it as soon as possible. So there's two verticals. There's going to be a bull put side and a bear call side that you'll see. It is risk defined, which means going into the trade, when you execute it, you know exactly how much you can risk at that point, what the max risk is and so forth. But on the other hand, there's also a limited profit potential, which equals the amount of the premium that you've taken in on selling the Iron Condor. So here, there's no directional bias, and the Iron Condors are profitable on a decrease in the volatility, in the implied volatility, and minimal movement. That's the range bound piece, the range bound visual that I just showed from that chart from the underlying stock. The Iron Condors are composed of 4 options of the same expiration. There's a long put that's further out of the money and a short put closer to the money. And there's a long call further out of the money and a shorter call closer to the money. Okay, that's what the 4 different options. So you're looking at 2 shorts and 2 longs. We'll get into the details in a little bit, but that's just the composition here of the Iron Condor. And as I mentioned, the profit is capped at the premium received, and the potential loss is capped at the difference between the bought and sold call price strikes and the bought and sold put strikes minus the premium that you received. And I'll go through that in a visual on a trade chart as we move forward. Anybody have any questions on this at this point? Okay, thank you. So moving on. So here's the Iron Condor's general trade setup. I'll get into a little more details on the checklist of what I go through to see if I actually want to do this setup. And I want to go through this. It's a little more complicated than your typical buying a call or buying a put, and it's a little bit more difficult than just buying a credit spread like we went through last week. So what we're basically doing is these top two bullet points is where that's the bull put side of things. The bottom two is the bear call side of things. So we're going to be setting up a range, which you'll see visually soon. And if during that time period, which I'll talk about shortly, if during that time period the stock stays between those two strike prices, then that's when you're going to be able to keep most, if not at least half of your premium based on your own particular preferences. I'll go through mine shortly. But if it can go outside those range, which means maybe it's going up faster than you thought, or it broke into an upward trend, or it's going down and breaking into a downward trend. That's the purpose of the long calls and puts that we buy. It kind of gives you like an insurance policy. I'll show you that in a short bit. But regardless of how, if it breaks through there, again, remember that our risk is predefined, and we'll understand what that is based on that the insurance policies that we buy in there. Okay. So we're going to be buying one out of the money put. We're going to be, as it says here, this is the protection against a significant downside move to the underlying asset. And then we're going to be buying one strike price further above the current price. This will protect us against substantial upside movement. Okay. All right. No questions? Thank you. Forward here. All right. So here's the setup, basically my checklist. So first of all, I want to determine if the stock's direction, that should be an is, I'll have to correct that, is neutral or range bound. And we went through that CCK stock example. So I want to make a determination using support and resistance lines as best as possible. Let's see if we're in a range bind. Sometimes you can just see it just looking at it. Does it look, without putting support and resistance lines? It helps putting them in there, but you can also see and eyeball it if need be. But I would recommend putting in those lines or purchasing the xBrat Guardian Zones to help do it automatically for you. So anyway, if I've determined that we're neutral, then that's the first thing. Then I want to analyze the stock's implied volatility and determine if it appears to be near its top. So let me go to the screen here. So this is NVIDIA. I'll see if I can find one. So if this was the range bound one the price I was looking at, the stock I was looking at, if this was the one I was interested in, my first thing I've noticed is that the implied volatility rank is really low. It is right about at historic lows there, and it's got a value right here of 6.57, which means that only about 6.6% of the time has the implied volatility been lower than where we are in right now. So that doesn't bode well for a credit spread. So I would, if that was the case, it would not meet my criteria, and I would not take NVIDIA as a range. Even if it was range bound, I would not take it at this point in time as an Iron Condor, because I want to see the Iron Condor's implied volatilities in these around this green line or higher, or even somewhat you could have it in this range, but this is just too low at this point in time. So let me see if I can find a stock that might. Let's just check. Let's pick one. That's still low. I may not have luck on today's. This is real time. Starting to move up, but that's still. I'm not going to do this for too long. I just want to see if I can. All right, so here's one. This is Comcast, At this point in time, you can see on this subgraph here that the implied volatility is now in line with historical volatility. It looks like it's moving upwards. And you can see down here that it's crossed the red line on this graph where it's on its way to. We're real time at this point in time, so that just ticked down a little bit. But so if this was the one that was range bound, I would check off the box saying good. Our applied volatility is in the right, starting to move in the right direction. And I would consider this a check on the boxes. I would like to see it more in this red and green area, but for this purpose of this session, it's close enough to the red that I would at least check off the box and say we're in pretty good shape there. So let me go back to, any questions on that? Okay, thanks. Next thing I want to do is I want to determine if the stock's earnings reports are greater than 14 days, or is greater than 14 days out, and the ex-dividend date is greater than 21 days out. So with that said, I want to go back over here, and you can see with the Comcast, we're definitely far enough away. It looks like earnings report hasn't been released, but they're looking sometime in late January. So we're in good shape from that perspective. And the ex-dividends is also, the dividend dates is still at least since January. Yeah, so we're at least a month or so from that as well. So so given that, I'm going, that checks off another box that we're in good shape moving forward. The reason they would be careful with the implied volatility is because you could have a run up with risk, as more and more people aren't sure, stuff like that. You could have your implied volatility increase at that point in time. So you don't want that impacting your decision at this point. So let's we did check the stock earnings and all, everything looked good there. So we can put another checkbox, we're good there. And then what you want to do is you're going to choose the expiration date. Now this is just my preference from experience and so forth. But you want to choose the expiration date such that they're somewhere between 21 and 45 days to expiration. So I'm going to go back to the Thinkorswim platform, and I'm just going to go to an options trade, and let's stick with the Comcast here. Close this up. So as I mentioned here, we were looking for 21 to 45 days to expiration. So on Thinkorswim platform, in these parentheses, and I'm sure they have it, every platform has their own version out there. You can see in these parentheses how many days it is to expiration. So it looks like if we're looking between 21 and 45 days, we have 3 choices out here. I'm going to take the closest. I tend to choose myself the closest to 21 that I can take, only because you're really close to that last portion of the slope when it drops off real quick and time decay / theta come into play. So for purposes of this presentation, I'm just going to pick the December 29th option. So what I do usually, I look at, this is customizable. So it all depends on each of your platforms that you might use. But I always like to put the volume, the open interest, the delta, the implied volatility, and then the bid-ask price on there. Now, one thing about the bid-ask price is that since we're selling, you're going to be looking at the bid. And if I hover over the bid price here, you can see sell, the little sell icon pop up. If you're just flat out buying, going debit trades, you're looking at buys. So we'll be looking at the bid price here when we actually put the price, the trade together. Right. So there's no questions there. We know that now we go back here. We've chosen the expiration date in between that time period. So good. Another check box. So now what I want to do is choose the short strike price with a delta that's less than 20% for both the call and the put. So remember, this is a multi-legged, 2 verticals. So what I typically do, so we're going to be buying and selling both calls and puts. So when I'm looking at down the delta column, I'm going to look for something, and you can see the implied volatility is also very close to the 20%. So if this was what I would do here is say 23 is close. If it was 19 or something like that, if it was lower than 20 but right across, I would probably use that instead for probability on our side. 13's a little bit too low from the amount of premium that we can get, so I'm going to stick with the 23 and the implied volatility. There's a 20% chance. So what you do is you go over, there's multiple ways you can do this, but on the Thinkorswim platform, this is what I do. Hover over the cell of that particular premium. We're looking at the 45 strike price, okay? So we're selling, so I'm going to choose sell, and I'm going to go down, we're doing an Iron Condor. All right, so you can see there's 4 legs. I talked about multi-legs. You could do these all individually as well. It's just more complicated around the credit, understanding the credit that you'll receive for the trade. So I'm going to actually bring this down to just one contract. We're at a 70 cent at this point in time, so I want to show you what that means. If I were to confirm, I'm not going to send this in yet, but I wanted to show that our max profit at the time is $68. Our max loss will be 32. So that's the worst that we'd be able to do on this particular trade. So I'm going to go back to edit here. So we see the 68. So there's 2 ways that you could potentially, if that's just for one trade. So one way you could do, if you want more than 68, like you could increase it. So let's just say that we increase it to 5 contracts. Okay. And if we were to go back and hit confirm and send, now we're looking at a max profit of $340. Okay. And the max loss would be 160. So that's one way you could do it, is just by increasing the number of contracts you want to sell. The other way, and let me put this back down to 1, is you can change the spreads between your short prices and your long. So let's say instead of a $1 spread, maybe you want your call, let's say we want a $2, we'll just say a $2 spread. And likewise, we're going to take this down to 42. So now we have a $2 spread, and you can see that the credit received is up to $1.09 now. So if we were to look back here, we would get $109 versus before it was 68. But our max loss has increased from 82 to 91. So that's something that you have to keep in consideration when you're choosing. Now you could also stay here and use both the change of the spread, and you could change the quantity. So if we move this back up to 5, we're at 110. We're going to confirm and send. Now it went up from 450 up to 555. Our max loss, however, is now 445. So that's just some of the things that you have to take your own individual preferences and your ideals of risk management, trade management, and so forth, as a forethought to which ones you want to put onto the board for yourself. Any questions on that? Okay, so now we have let's say we're going to go with this. So we have our strike prices for our shorts and our longs here. Let me go back to the checklist. So we've done this, and now we want to I want to go back and analyze the short strike prices against current support and resistance. So let me go over to back over to this part, and let me see if I can just throw on CMSA. Now this might take a little bit to get that on there. So while that's loading up, I want to go back over to the board here. So we're going to look at the reason I want to look at the short strike prices against the support and resistance. So I want to make sure that we're not picking a price level that's too close into the range of the support and resistance, just so that we have built a confidence level, and that the zone range that we picked may keep that stock in that range. And so if we pick something that's slightly higher than the range, that's okay. If it's something lower than range, that's okay. But if it's in the range but lower than the range that we're looking at right now, that may cause us a little bit of less confidence in it. It's not going to say it's a bad trade, but I'm just looking to try to put all the check boxes in place that would give us the best probability for a successful trade at this point in time. So let me go back, see if that's still loading up. That chart's running on a virtual server, so that takes a little bit longer at times. Okay. Okay. So that was the short strike prices that we were talking about up here. I already, since we'll go back here, I already threw in the calls, so we'll go over that while the range parts being drawn up or rendered on that chart. So going back here, you can see the pluses and so forth. They're the calls, and that's the insurance. So you're gonna. So what happens, and we'll look at it on a graph, a risk profile graph shortly, is that this difference here, that $2 spread, is if the underlying strike of stock of Comcast hits this price range, that's when that exceeds this one. That's when the exceeding of this is when we start going. You'll see a flat line, and that's where we've maxed out our potential loss. So the loss will fall in from 45 to 47 range minus the premium that we got in there, and likewise we're buying an insurance policy put below that value, and again it's the gap in between these two minus the premium, or the premium that we got for that that's offsetting the risk that we're incurring on here. Hope this still not popping up yet. All right. Here. Okay. The other thing is we want to ensure that the credit risk is no more than 4 to 1. The credit you're receiving to the risk is no more than 4 to 1. So if I go back over to here and I'm looking at the confirmation, we can see that we're definitely not in a 4 to 1 ratio here. Our profit is $510. We could take the risk all the way down if you multiply that by 4 to $2,000. That still would have been a favorable trade. But this is really good right now. We're almost at a 1-on-1 credit to risk. So this itself checks off this credit risk here, and then enter the trade if possible. Now, if we like that, I'm not going to enter it right here, but if we like that, we would want to note, prior to entering a trade, we want to note the delta values for the short legs. And let me go back over to here. So what you want to do is, if we like this trade, before we confirm and send it through, you want to go to each of the short legs. So there's 2 of them. So there's the 45 call. So you go to 45 and go over, and you want to jot this number down, 0.23. Okay, that's the delta at this point in time, at the time of the trade. Then we want to go down and look at the short put, which is the 44. So we want to go over here and jot down the delta, which is 0.63. Okay, just jot that down in your trade journal or however you want to track it, but jot those 2 numbers down. It'll come into play during some trade management options. Okay. Check this. Still doesn't look like we're rendering there, so I'm going to go back. Well, maybe, let's see here. Okay. So let me just use this as an example here. Again, if this was the Comcast stock, what I'm basically saying is that we want to analyze. It's not saying make sure or certainty, but we want to analyze the short strike prices. So we were looking at the 45 and the 44. So let's pretend that we were at 90. Let's say we're looking at the 98. And down here, we're looking at 84. Say they were our short prices. They're not in this area here. They're either in the current support and resistance zones, as you can see, or they would be above or below, depending which side of the put or calls you're looking at. So if that was the case, then we have a favorable situation there as well. Again, it just adds a little more confidence to the trade. It's not, this one is a nice to have. It's not a necessary one, let's put it that way. So now we've entered the trade. We've noted the delta values. Before we move on, is there any questions? Okay, like I said, you can always ask questions in the MS Teams channel as well. So from a trade management perspective, there's the more simplistic one is take profits at 50% of the credit received. Okay, so what does that mean? All right, so if I go back, you'll want to jot down, or you'll probably know just from the open, the trade comes through. But if you purchased this at 106, okay, that means, or I'm sorry, if you sold that to someone at 106, then you've got two options. You could buy back this trade, you can buy back the Iron Condor yourself, or you can let it expire to zero, where you would get the entire 100% of the premium collected here. So let me just hit this confirm button. So if you were to let it totally expire, you would collect $530. You'd get to keep it. Okay. What I'm saying here is that you have the, what I typically do is I'll take profits at the 50% of the credit. I won't, that's just my preference. You can choose how to do what you want. So what that means is if let me go back out to the edit. If we're getting 106 or $1.06, and if I just divide that by 2, what's that, 53? 53, yeah. So as I'm watching this each day, once it goes down to 0.53 or lower, that's when I would sell this, buy this back and get 50% of that $500 some to keep. When you open up, what I typically do is that once that trade is open, I would go through and do an OCO type of order, so that if it hits 53 or better, then it closes. Or I'd also put in there, because the other part of it is, if one of the Iron Condor wings hits the short side, exit that wing, then manage the remaining open wing. So if it's dropping and hits one of the short sides, you would close out that wing. Let me actually go into the what the risk profile looks like, because it's a little bit easier to see what we're talking about here. Let me put this on to analyze the trade. And this is what an Iron Condor physically looks like. And I guess they call it an Iron Condor because it looks like a big bird with these wings on the outside. So what we have here is we have both the bull put and the bear call spreads on here. If you look at the 45 right now, that's the one side of the short price, and on the call side you can see we're at 44, so that's over here. So the hope is that by December, we picked December 29th, that the Comcast stock, the best thing would be for it to fall into this area and stick in this range here. The magenta line you see here would show you as of this date, December 4th, where we're at, based on where we're moving and moving our cursor here and so forth. So you can see where the break-even lines are. There's a little section in here that shows all that. But I want to just show you visually what we're looking at. Now, this is the max. Now, you can see if we're looking at the 525 over here on the magenta side, it says 525. And then you can see where it starts deteriorating some as we're moving closer and closer. And then when we finally get to the 42 put, that's when you can see we've bottomed out. We can't do any worse than the 475, but and that's where it's a risk defined right now. We can see wherever that level is. It's just this stock could keep moving down and down and down, but once you hit this level, that'd be your max loss. And if you hit up this level, no matter how high the stock went, excuse me, that's your max gain and stuff. All right. Any questions on that? Okay. All right, so I'm going to take the profits myself at 50% credit received. So when I'm watching my monitor over here and I have my trade in and so forth, or sometimes what I'll do is you can do set up alerts as well. So if I pick the Comcast stock, you can create alerts up here. You can create alert, and you can pick it off of your Iron Condor. However you want to set up different options and stuff like that. You can set that up, and you'll get an alert then when you've hit one of those legs if you want to watch it that way too. So you can either do OCO orders or on each leg, or you could do just put alerts up or monitor manually, as you see the number changing. It was 109, now it's at 107. So if that dropped down to 0.53, that'd be your trigger, if that's your choice, to close out that options trade. I know there's a lot to go through and so forth. Just, please let me know if you have any questions. This recording will be out there. You can type in questions from there as well. So let me go back to, now there's some optional price. Let me go back here. It says if one of the wings hits the short trade side, you can close off that side and you could still have the one that's working in your direction going. There's something does not mean you have to take, you don't necessarily have to close everything out, but if one of the iron wings, like I said, that the short side's hit, exit out of that and then keep the other side open, and then it turns into just a regular credit spread at that point. And then you would just exit the trade if that remaining short side got hit, or you get your 50% of the credit. Okay. Optionally, if the underlying stock is moving up and the bull put delta, this is when you keep tracks of your deltas that we talked about. If that changes by more than 20%, so let's say it was 0.2, I think it was 0.23 when we were looking at it. If that moved up to 0.43, then we would want to close out the bull put wing and open another bull put wing with a delta that was also 20 or less. And likewise, we would do the same thing on the underlying stock. If the bear calls delta change by 0.2, we would close that out. So basically what we're doing is, let me go back to the visual. So if one of the sides was, if the stock was heading down, and this, you'll be making money on this side if the stock's moving down. So you would just close out this spot and then look back on the options chain. Oops. Back over here to trade. You would go back down here and just look for, if you had closed out the call side, you could come back down here, look for another one that's close to 20 and put that one back on. And then when you look at your analyze, then you would have a new strike prices for the new bull put that you put out there. Likewise, you could do it on the call side or the put side as well. So whether you're doing the bear call or the bull put leg, you can just add them back on. It's a little, it takes up more of your time and so forth, but it is a valid way to do trade management at this point. This is a little more complex, so please feel free to let me know if you have any questions on that. All right, let's see. And that's all I got for today. I'm gonna, like I said, once this recording ends shortly, I will post it up onto the team site, and I'll put a post in there that it's available, and I'll also put the PowerPoint slide deck out there with it. Thank you for attending. Again, if you have any questions, please let me know, and I'll do my best to get you the answers quickly as possible. Okay, have a great day. Take care. Talk to you later. Bye-bye.